Welcome to the debate. Our focus today is on a recent overview of the global financial markets, which seems to describe a pretty significant shift in mood. We're moving into a more cautious, more selective phase after a period of really aggressive growth.
Yeah, it's a real change in market behavior, and it forces us to ask, what's really behind it? What is the dominant force that's driving this slowdown and making everyone so risk-averse all of a sudden?
And that's the central question for us. Is this caution being driven primarily by a very specific uncertainty around tech valuations and AI profitability? Or is it really just the macroeconomic reality of high U.S. interest rates setting the new rules of the game? I'm going to argue that the skepticism aimed right at tech is the real defining driver here.
And I'll be making the case that the signals we're getting from the Federal Reserve about keeping rates high are the true structural constraint. This macro factor is the foundation, and it's exposing vulnerabilities in speculative sectors like technology.
The pressure we're seeing, I think, is fundamentally rooted in sector-specific skepticism. I mean, yes, the economic context matters, but global indices are slowing down because of a very real investor concern over the speed and, frankly, the sustainability of tech growth. The material says it directly. The big tech stocks, especially the ones tied to AI, are seeing noticeable selling pressure. And this is being triggered by a very explicit question investors are now asking: will all this massive spending on AI actually deliver the profits the valuations demand?
Okay, I see why you'd focus on that question, but I'd argue that this sudden questioning of AI profits is really just the most obvious symptom of a much larger constraint, which is the high interest rate environment. The material is very clear that the Fed is signaling that early rate cuts are, well, highly uncertain. That immediately changes the entire financial equation by pushing up U.S. Treasury yields, and it specifically points to the pressure on the 10-year.
But the behavior being described is so targeted. Investors are moving away from just, buying everything aggressively, and they're starting to carefully look for specific buying points. That's a deliberate behavioral correction, and it's tied to this feeling that the tech space just got way over its skis. It's an internal concern about tech's ability to deliver, and that, in my view, is the catalyst, not just a side effect.
I just come at the mechanism from a completely different angle. When the foundational cost of money goes up and everyone expects it to stay up, it acts like a brutal discount rate. So high-growth stocks, whose big earnings are years down the road, suddenly become incredibly sensitive. They're the first things people reassess. The rate signal from the Fed is the mechanism that makes everyone wake up to risk. The tech uncertainty is just a reaction to that painful math. It is the engine of caution.
So let's focus our first point squarely on that, on causality. Are the high rates just the precondition, or is the tech valuation risk the actual trigger?
I'm arguing for precondition. The systemic pressure from rising Treasury yields forces investors to re-examine anything that looks speculative. I mean, when the base cost of money goes from basically zero to something structurally high, the return you need for taking on any risk has to go up too. That high hurdle rate is what suddenly makes these stretched tech valuations look completely unsustainable. The macro environment is setting the terms.
That's a compelling point about the systemic pressure. I'll give you that. But I think you're confusing the context with the catalyst. High rates create the pressure, sure, but the actual selling, the thing that tipped us into this cautious phase, is specifically triggered by doubts about AI's return on investment. If high rates were the only thing driving this, we'd see a much more uniform sell-off across all rate-sensitive sectors, utilities, real estate. But the story, as the material tells it, is so focused. Investors are being explicitly warned to be wary of tech and AI. That confirms this specific anxiety is the primary lever here.
But that warning only has teeth because of the structural pressure. I mean, investors always have questions about future profits. The difference now is that the opportunity cost of holding speculative tech has just exploded because you can get a safe return from high yields elsewhere. The high yields don't just prompt caution, they change the actual math of valuation. And that is a far more powerful driver than just questioning a business model. Investors don't sell until the environment forces their hand, and high rates are what's forcing their hand.
That does raise a fascinating question, though, about the global reach of this. If high U.S. rates are truly the one controlling factor, shouldn't we see that dominance everywhere, in every asset class?
Which brings us to our second point, the evidence from what's happening in peripheral markets. I think these other markets show that macro forces aren't uniformly dominant. If the U.S. rate environment was completely dictating global capital flows, you'd expect just overwhelming strength in the U.S. dollar and capital rushing back to the U.S. But we see more nuanced things happening. For instance, the price of rubber went up in Tokyo, and that was partly linked to a stronger Japanese yen. The fact that a local factor, like a shift in Japan's monetary policy, is strong enough to, dilute the high rate narrative suggests that the U.S. macro pressure is powerful, yes, but not the only story.
I'm sorry, but I just don't buy that. An isolated move in a commodity future, or one country's currency recovering, it doesn't outweigh the systemic risk we're talking about. While those local factors exist, the bigger picture is that the high-rate environment in the U.S. is fundamentally warping global capital, and that's where the real systemic risk is building. The source material warns that certain carry trades, where investors borrow in a low-rate currency to invest in high-yield emerging markets, are getting dangerously crowded.
Can you explain the specific risk in that crowding?
That's absolutely. This concentration of risk is a direct result of the hunt for yield. With safe high returns in the U.S., investors who still want more are forced to take on bigger and bigger risks elsewhere. When those trades get crowded, any tiny shift in policy or currencies can trigger a massive, rapid unwind. That injects instability into the entire global system. And the creation of that vulnerability is proof of the pervasive, controlling influence of higher U.S. rates.
That's a very strong point about systemic risk being pushed outward, but I think that speaks more to a consequence of high rates on these leveraged strategies than to high rates being the dominant driver of the market slowdown itself. I mean, the defining feature of this cautious phase is the active selling in one specific sector, technology. That's where the money is actually moving.
But that brings us right to the third point, how investors are actually behaving, how they prioritize these concerns. I mean, the conclusion in the material suggests a very clear order of risks. It puts high-level factors first, policy risk, interest rate swings, and then it gets to the technology and AI sector. That ordering reflects the reality that policy risk is the umbrella concern that frames every single investment decision, including pulling back from pricey tech stocks.
I'm not convinced that the order on the page defines what's actually dominant in practice. The core action described in the material is this active questioning of AI profitability, which is an internal issue, right? It's about CapEx versus future returns. So while policy risk is listed first as a general threat, the concrete evidence of market friction, the actual selling, the hard questions, is located firmly and repeatedly within technology.
Okay, let me challenge that. The conclusion says the slowdown is happening because risks have been revealed and investors are starting to select carefully. So I'll ask again, what forced the revelation of that risk?
The revelation was forced by internal company data on the sheer scale of capital spending needed for AI, which pushes profitability further out. The selection process is focused squarely on tech's ability to deliver. That makes the specific valuation risk, a risk inherent to that growth model, the most immediate pressure point for investors today. High rates might tell you why to be cautious in general, but doubts about AI returns tell you where to be cautious right now. And that where is what's defining this slowdown.
But that selective caution is just the rational outcome of an expensive sector colliding with an expensive cost of capital. You can't separate the two. Growth stocks are built on optimism and cheap money. When the cheap money disappears, the optimism is the first casualty. Those rising yields are a structural barrier that fundamentally changes the viability of the sector's valuations, proving the macro factor is the ultimate constraint.
So I think this debate really highlights the complex interplay between macro forces and sector fundamentals. While yes, high rates set the stage for prudence, the current market pause is, I maintain, defined by an investor retreat from AI-linked stocks. It's driven by internal skepticism about growth and returns. This selective skepticism confirms that valuation risk is the immediate lever of the current slowdown.
And conversely, I would say the macroeconomic environment defined by the Fed signaling high rates and the rise in Treasury yields is the fundamental, non-negotiable constraint that makes all high valuations questionable. This environment doesn't just pressure tech, it increases systemic risks everywhere, like with those crowded carry trades. It demonstrates that the higher cost of capital is the structural factor dictating the entire market's reduction in risk tolerance.
Both the uncertainty in AI returns and the prospect of sustained high interest rates are, without a doubt, powerful forces shaping the market today.
Right. And understanding which one is exerting the more profound influence, the structural constraint or the specific trigger, is going to require continued attention to how these pressures play out. There is clearly much more to explore here.